History does not repeat, but it rhymes. And right now, the financial markets are rhyming with some of the most explosive, dangerous, and profitable moments in economic history. While the mainstream media has been obsessed with day-to-day volatility, a fundamental shift has occurred in the architecture of the global financial system. It happened quietly, buried in technical reports and committee statements, but its implications are earth-shattering. The Federal Reserve has pulled the trigger. For the last 2 years, we have lived under the shadow of restriction, high interest rates designed to crush inflation. But in late 2025, that regime ended. The Fed didn't just cut rates, they fundamentally altered their philosophy. They switched from fighting inflation to protecting growth. This decision, combined with a massive, underreported fiscal stimulus package from Congress and a historic explosion in technology spending, has set the stage for what analysts are calling the 2026 Market Thesis. It is a setup that mirrors the conditions before the dot-com melt-up of the late 1990s. It is a convergence of monetary accommodation, fiscal injection, and technological mania. Welcome to the Financial Coin Historian. Today, we are not looking at the past to mourn it. We are looking at the past to decode the future. We are going to deconstruct the mechanism of the coming rally. We will explain why the one big beautiful bill might be the fuel for a fire the Fed cannot control. We will analyze the $400 billion bet on artificial intelligence. And we will ask the ultimate question: is this the start of a golden age or the final euphoric stage of a bubble about to burst? This is the story of the 2026 market rally. To understand why 2026 is poised to be a year of explosive market action, we must first understand the signal that was fired in late 2025. For years, the Federal Reserve had one mandate: kill inflation. They raised rates, they drained liquidity, they promised pain. But in late 2025, the narrative broke. The Federal Open Market Committee, or FOMC, executed a decisive policy pivot: the insurance cut. They lowered the target range for the federal funds rate by a 1/4 percentage point, bringing it down to the 3.75 to 4% range. On the surface, a small cut. But in the language of central banking, this was a scream. Why? Because inflation was still somewhat elevated. Core inflation was hovering around 2.8%, well above the Fed's 2% target. Historically, a central bank does not cut rates when inflation is sticky unless they see something terrifying on the horizon. The Fed explicitly acknowledged that downside risks to employment rose. This is the key. The Fed decided that the risk of a recession, of people losing jobs, was greater than the risk of slightly higher prices. They chose to provide insurance against an economic collapse. This is exactly what happened in 1995 and 1998. The Fed cut rates not because the economy was crashing, but to make sure it didn't. Both times, those insurance cuts fueled massive stock market rallies. By validating the soft landing, the Fed effectively told the market, "We have your back." The end of quantitative tightening, but they didn't stop at interest rates. In a move that received far less attention but carries equal weight, the committee decided to conclude the reduction of its aggregate securities holdings, known as quantitative tightening, or QT, on December 1st. For years, the Fed had been sucking liquidity out of the system by letting bonds roll off its balance sheet. Ending QT is like opening a dam. It stops the drain. By simultaneously lowering the cost of capital, rate cuts, and stopping the liquidity drain, ending QT, the Fed injected a maximum liquidity boost into the veins of the financial system. This is the foundation. The cost of money is falling, the supply of money is stabilizing, and the central bank has signaled that it prioritizes growth over inflation. For asset prices, this is rocket fuel. Monetary policy is powerful, but it takes time to work. It is a blunt instrument. To get a true market explosion, you need a second engine: fiscal policy. And unknown to many casual observers, Congress has loaded a fiscal cannon aimed directly at 2026. We're talking about the legislation colloquially known as the One Big Beautiful Bill Act, or OBBBA, the deficit stimulus. While the Fed is trying to ease conditions, the government is preparing to flood the economy with cash. The OBBBA is a massive deficit finance tax bill. It is projected to increase the federal deficit by approximately $4 trillion over the next decade. In 2026, the deficit is expected to run at a whopping 6 to 8% of GDP. To put that in perspective, the U.S. government has never run deficits this high during an economic expansion. Usually, you run deficits to fight a recession. Running them during a boom is like pouring gasoline on a bonfire. Direct injections. The bill includes specific measures that will hit consumer bank accounts in the first half of 2026. Retroactive tax cuts. Many provisions are retroactive to 2025, meaning households will receive outsized tax refunds early in the year. Standard deduction increase. The standard deduction rises to $3,200 for married couples. Targeted relief. new deductions for car loan interest, and increased credits for childcare. This is direct liquidity. It increases disposable income. And in a consumer-driven economy, that money flows instantly into corporate profits. Bank of America explicitly identifies this fiscal boost as a primary reason for their above-consensus GDP forecast for 2026. This creates a unique dual stimulus. Usually the Fed and the government work against each other. One taps the brakes while the other hits the gas. In 2026, both are hitting the gas. The Fed is cutting rates. The government is cutting taxes. This synchronization is rare, dangerous, and incredibly bullish for asset prices in the short term. So, we have cheap money, monetary, and extra cash, fiscal. But what are investors going to buy? Every great rally needs a story. In the 1920s, it was radio and automobiles. In the 1990s, it was the internet. In 2026, the story is artificial intelligence, the 400 billion bet. The market narrative is fundamentally driven by a powerful innovation cycle led by AI. But this isn't just hype. It is backed by cold, hard cash. We are witnessing a capital expenditure, CapEx boom, that rivals the Industrial Revolution. Forecasts for big tech CapEx, money spent by companies like Microsoft, Amazon, and Alphabet on data centers and chips, have surged to a projected $405 billion for 2026. Some estimates suggest it could exceed $500 billion. This spending is a direct injection into the economy. It buys concrete, steel, energy, and labor. It creates a K-shaped quant economy where the tech sector acts as the engine pulling the rest of the train. The productivity miracle. Why are companies spending this much? Because they believe AI is the key to a productivity miracle. Labor productivity growth has already accelerated to 2% over the last 5 years. Goldman Sachs projects that AI adoption will sustain U.S. potential GDP growth at elevated levels through 2029. This higher productivity is the magic bullet for the stock market. It allows the economy to grow faster without causing inflation. It justifies higher price-to-earnings, PE ratios. If companies can make more money with fewer workers using AI, their profit margins explode. Analysts are using this AI productivity thesis to justify valuations that would otherwise look absurdly expensive. They argue that we are in the early innings of a technological revolution that will reshape the global economy. Whether that is true or delusion doesn't matter for the rally. What matters is that the market believes it. Beyond the macroeconomics, there's a technical setup that favors 2026. We call it the slingshot effect. The year 2025 was volatile. Markets saw sharp corrections. But historical data shows that years which experienced significant drawdowns but close strong, like 1982, 2009, and 2020, often act as a slingshot for the following year. The volatility of the previous year clears out the weak hands. It builds a wall of worry. And when the fundamental drivers, rates, taxes, AI align, the market has the energy to surge higher. Institutional consensus is positioning for this. Major investment banks like Goldman Sachs and UBS are forecasting continued rate cuts throughout 2026, targeting a terminal rate of 3.0% to 3.25%. This Goldilocks rate, not too hot, not too cold, is the sweet spot for equities. Furthermore, as the Fed cuts, the US dollar is expected to weaken. A weaker dollar is historically great for global assets and U.S. multinationals whose foreign earnings become worth more. This broadens the rally. It is not just a tech story anymore. It becomes a small cap story, an emerging market story, a cyclical story. However, as financial historians, we must look at the shadow. Every boom carries the seeds of its own destruction. The 2026 thesis is incredibly bullish, but it is built on a knife's edge. The greatest risk is what we call policy coordination failure, the inflationary boomerang. Remember the dual stimulus? The Fed cutting rates while the government injects trillions in tax cuts? That is a recipe for overheating. If the economy accelerates too fast, if GDP pushes past 2.5% or 3% while the labor market is tight, inflation could roar back. We are not talking about a gentle rise. We are talking about a resurgence that forces the Fed to panic. The consensus assumes inflation will converge to 2%. But what if the OBBBA stimulus pushes demand so high that inflation stabilizes at 3% or 4%? The rate hike shock. This leads to the rate hike shock scenario. If inflation reaccelerates in mid-2026, the Fed will have to reverse course. They will have to stop cutting and start hiking. The market is absolutely not priced for this. Billions of dollars in derivatives, debt, and equity positions are betting on lower rates. A surprise rate hike in 2026 would be a financial violent event. It would disproportionately punish the high-growth, long-duration AI stocks that led the rally. It would be 1994 all over again, a bond market massacre that spills into equities. The AI bubble burst. There's also the risk inside the machine itself. The AI rally depends on those massive capex numbers translating into profits. But there are concerns about circular financing deals. Tech giants investing in startups that simply use the money to buy cloud services back from the giants. It creates the illusion of revenue. If investors start to realize that the $500 billion spent on AI is not generating $500 billion in real-world utility, the productivity narrative collapses. And when the narrative breaks, the valuation multiple collapses with it. So how does one navigate a year that promises a melt-up but threatens a meltdown? The institutional strategy is clear. Embrace the rally, but hedge the tail risk. Cyclical rotation. The smart money is moving beyond the Magnificent Seven. They are looking at small caps, Russell 2000, and cyclical sectors like financials and industrials. These sectors benefit most from the Fed's rate cuts and the domestic tax stimulus. Fixed income duration. With the government issuing trillions in new debt to fund the OBBBA, long-term bonds are risky. The supply of treasury bonds will be massive. The strategy is to stick to intermediate duration. Lock in yields without taking on the risk of a debt spiral. Real assets, gold remains the ultimate hedge. In a world of dual stimulus and potential overheating, gold serves as insurance against the policy coordination failure. It performed well in 2025 and is expected to continue as a hedge against geopolitical fragmentation and dollar debasement. The Federal Reserve has set the stage. They have unlocked the liquidity, Congress has written the checks, Silicon Valley has built the engine. 2026 is primed to be a year of historic market performance, but we must remember the lessons of history. The Roman Empire debased its currency to fund its expansion, creating a boom before the bust. The roaring 20s were fueled by easy credit before the crash. The 2026 rally is built on the same foundations: debt, liquidity, and faith in a new technology. For the prepared investor, this is the opportunity of a decade. For the complacent, it is a trap. The market is going to run. The question is, will you know when to leave the party? This is the Financial Coin Historian. History has given us the map. Now it is up to you to navigate the territory.